everyone, and welcome to the Always On Point podcast here with Kristen Ambos. Want to get going today right away. We got a lot to talk about. The next two episodes are going to be amazing, so please listen up because there are a lot of what I'm hearing. Boots on the ground loan officer here. So not an order taker, not a pencil pusher, but actually boots on the ground where I'm talking to real estate agents, talking to clients all day, every day. And here are some things that I thought were really important to share. That are very important to our market, very important to both agents and consumers, as well as loan officers, right? So our job as a loan officer, a boots on the ground loan officer, is to strategize with you as the consumer, to strategize with you as the real estate agent, to make sure that we're setting up our pre-approvals as best as we can so that both the buyer and the agent, selling agent, sellers, everybody in the transaction takes this to the closing table, because at the end of the day, an accepted offer is huge, but it only counts when it's actually closed. And closed is what we want to see on every deal. It's where we want to win. And so some of the things that I've seen recently that are drawing some attention, thought was really important to talk about, are a few different things. So first things first, the comeback buyer. Let's talk about it. So 2 years ago, a lot of buyers who were pre-approved got out of the industry, got out of the game because rates went up. And rates went up. I think the high was right around 7.8. Don't quote me on that, but we all know they went up higher than anyone wanted to or anyone thought they would. And what it did was that interest rate really priced a lot of people out of the market. At that point, it wasn't necessarily about not having enough funds to close, but it was about not being able to qualify with debt to income ratio. And now the payment that they once thought they had went up $200 a month. And that was whether or not, they would be able to pay another bill or things like that. So a lot of them genuinely got out of the market because they felt like it was too expensive. Totally understood. Now rates are down into the mid sixes. Just so you all know, when the day we are shooting this, the average mortgage interest rate on a 30-year fixed is right around 6.75. So yeah, they're up. This is after the new Fed chair is in. Jobless claims, you name it, all the inflation is up, all the different things. Well, those are coming in to now fruition along with the war. And that's really starting to hit pocketbooks of your daily person, of your actual borrower. And when now you start squeezing into their daily life, their gas prices, their grocery prices, anything to do with oil and how it gets to the United States, which is pretty much everything, has been affected monetarily. And people, again, are feeling that. But interest rates are down. Even though they might be in the mid sixes, they're still down from the upper sevens, right? Which is, again, about a $200 a month swing to payment. So people are sitting back going, okay, now there's down payment assistance. Now I feel a little bit better about going into a loan, right? Going into a mortgage. And that $200 a month is sitting better for me. So now they're coming back into the market. They want to buy. Couple of things to talk about with move-up buyers or buyers moving back into the market is, what did they do in that interim? So even though they might have been pre-approved at a higher interest rate and rates are down, we cannot just assume that they're still pre-approved. Now, this is speaking to real estate agents and clients alike, because if you were pre-approved at a higher interest rate, the thought process says, well, then you should still be pre-approved, right? Right? I get that. The thing about it is, though, in that 2 years, as soon as people stop shopping for a home and they don't feel that immediate necessity of not being able to use their credit because they're going into a mortgage or because they think they might be going into a mortgage, then they start buying other things. They start buying cars. They start putting things on credit cards. And now those payments make a big change in their affordability, in their debt to income ratio. And right now, you guys, with an average car loan being around $700-ish, $800 a month, that's going to change a pre-approval quite extensively. So before you're a buyer or an agent talking to a potential buyer saying, yes, I was a pre-approved before, I know I'm going to be good now, please get with a lender. Please get with a lender and get pre-approved, because things in our industry on our side have also changed. The way we calculate income has changed a little bit. Variable income, talk to any loan officer, variable income such as hourly, which many people are hourly employees, has changed in its calculations a decent amount in the last 2 years. We want to make sure that we're still calculating that. Also, where a lot of employers would guarantee 40 hours a week are not guaranteeing that now. So if there's not a guarantee there, we might only be able to use your average hours of 36, 37 hours a week. Now, when you lose 4 hours a week on average, that's going to change your income quite dramatically when it comes to lending. So those are a few key reasons why if you were out of the business or out of the market when you were a buyer and you want to get back in, you will need a new pre-approval. Pre-approvals realistically only last about 90 to 120 days. So you want to make sure that you're coming in, which leads me to, the next point is if you're a buyer coming into the market again and you're going to get a new pre-approval, credit. I really want to discuss credit because there are a lot of lenders out there using that soft pull credit as a sales tactic. I'm not going to, I've always been real with you guys. I'm going to continue to be real. I lost a deal last week and I was pretty beat up about it. It took me a day or so to cool down from that one. The reason why I lost it, according to the buyers themselves, they looked me straight in the eye in person and said, "You told us we needed a hard pull. 2 other lenders told us we only needed a soft pull. So we did the soft pull. When you did the hard pull, our credit dropped a couple points." Now, there's a whole lot of reasons why credit can drop from doing a hard pull. Yes, maybe the same day I did a hard pull, they went out and used their credit card, and both those things together brought their credit rating down. The reality is their credit scores were into the 800s, and even if they lost 5 points, that was not changing anything to do with their financials. But because 2 loan officers who are order takers and not true strategists told them they could get away with just a soft pull. Don't worry, just a soft pull is good. Knowing that they're eventually going to have to do a hard pull. The client walked away from me. Now, here's what happens when you only do a soft pull. Which, can you do a soft pull? Sure. The thing I need you to know, and I think the thing that consumers really need to understand is when they're working with a mortgage loan officer and they're getting a pre-approval, they could probably get 3 pre-approvals and have 3 hard pulls in the same 30 days, and it's only going to count as one hard pull. Google it, ChatGPT it, look online. And when we pull a credit bureau, it's got a little M on it for mortgage. So that's how it knows that it's a mortgage credit pull. All right. The reason why they do that is because it is not the consumer's fault that the mortgage loan officer has to pull credit in order to give a fair pre-approval. They know that. Note to self, a soft pull may cost a few dollars less, but here's what a soft pull doesn't tell you: the entire story. And so if you are somebody out there who got pre-approved on a soft pull, you might put an offer in and now they're going to do a hard pull. And now a couple questions. Has your credit score changed? Because maybe you did you know that if you just use your credit card big 1 month and you don't typically do it, that you can lose points on that? That's not a hard pull. That's you using your credit when you don't typically. Why? Because something has changed in your credit. Okay. I'm not saying that I deal with credit as the expert, but what I can tell you is I've done a lot of research. I know a lot about credit. I've talked about my own story with credit. I stick with this really tried and true. And I've worked with credit repair companies who have discussed the same things with me. So let's say you have a $10,000 limit and you only usually use $1,000 on it. But this month you wanted to buy some new furniture, so you put $4,000 on it. So now you're using $5,000 of the $10,000. Your credit score will likely drop. Why? Because you went from utilizing 10% of your overall balance to 50% of your overall balance. That's a big swing. That one use of a credit card you already have in your possession, in your name, could drop your score. It's possible. And there's not a guide that says, if I do this, then I'll lose this many points. If I do this, then I'll gain this many points. That guide isn't out there anywhere. And if you have it, share it with me because I've been searching high and low for it for 25 years and it doesn't exist that I am aware of. So going back to it, you could do 3 pulls, 30 days counts as one hit. So even though I did it, there were a few soft pulls on there as well, right? It didn't hit his score to the fact where it was detrimental to him. But the fact that 2 loan officers told him that they only needed a soft pull and did not need a hard pull, they essentially lied to his face. And why I say that is because just to make sure I did my due diligence, which is super important, I contacted 3 loan officers that I know very well in my market. Another independent mortgage bank such as myself, a real bank, and I don't say real, but I mean a bank, a depository bank, as well as a mortgage broker. And I said, all right, guys, this is what I'm being told. Do you or don't you need a hard credit pull when you do loans? All 3 of them unanimously, without hesitation, said you need a hard pull. You cannot close a loan without a hard credit pull. In which case, which I trust them all, I said, okay, do you know of any lender, do you know of any other banker out there that can close a deal on a soft pull only? They unanimously said no. These are large banks, large independent banks throughout the country, and also a large bank, a regional bank in the Midwest. I trust what they're saying. I trust their underwriters. I trust that these banks know what they're talking about. So which then comes to the next step. You have people out there selling you that a soft pull will get you through to the end. But what they're not telling you is that they do have to have a hard pull themselves. What I've seen happen, and this is why I do a hard pull up front, is because if you do a soft pull up front and it doesn't tell the whole story, and now you've gone out with your real estate agent and you've been looking at homes, and you find the home of your dreams, and you've already fallen in love. That accepted offer is there. You've fallen in love. The real estate agent has done their job for you. They took the time away from their family and nights and weekends. They've showed you homes. They wrote a perfect contract. They got it accepted. Now you go into underwriting, and the loan officer sends everything in, but the underwriter sends it back and says, hey, you didn't do a hard pull on this. It's still in a soft pull. So I need you to do a hard pull so I can complete my underwrite. And lo and behold, at that time, you find out that your loan officer pulls your credit. Now, you already have an appraisal ordered, title ordered, insurance ordered, all of it. And that underwriter says, by the way, your soft pull credit report said you were at a 720. Your hard pull says you're at a 685 because 2 other trade lines came up and now your borrower doesn't qualify. Think about that. Think about how that affects everyone involved. The seller, the buyer, who thought they did their due diligence because their loan officer told them a soft pull was enough. You've now, a title company has already worked on title. An insurance company's already worked on insurance. An appraisal has already been ordered. An underwriter started that. Processors have already worked on that file. We've already started accumulating a lot of costs between credit reports, earnest money. Buyer might be out earnest money. Maybe, maybe not. And the seller has already begun packing and moving, and they probably already have an offer in, and maybe now that's going to affect the home they buy. All because that loan officer sold you on a soft pull when that wasn't going to get them through to the closing table. You don't want to be that person. You don't want to be that buyer. You don't want to be that loan officer. And you certainly don't want to make those phone calls. That is absolutely heartbreaking. And to the pencil pusher loan officer that's sitting on the side of their desk who never leave their office, who don't have any care in the world because they don't have to face anyone in their industry, goes to sleep at night and says, whoops, my bad. Wakes up the next day, does the same thing again to the next buyer who's going to listen, and the same thing again. And sometimes it's going to work where they're going to get lucky, and sometimes it's not. You don't want to be the one that it doesn't work for. That is a game I'm not willing to play. And if that means I have to lose a deal for a client because I'm protecting them, I'm protecting their offer, I'm protecting their real estate agent, and I'm protecting everything to do with that transaction, then I guess that's the hard pill I'm going to have to swallow. But that's what we're up against as loan officers right now, as tried and true loan officers who are doing the job to the best of their ability, making sure that our real estate agents have really solid pre-approvals and our buyers can really buy and truly understand all of the elements, all of the people, all the money that goes into these things. That again, if it doesn't close, no one gets paid for that stuff. It all drops. And the buyer might be out that appraisal money, might be out that earnest money. Now we might be talking litigious because this is an extremely litigious industry. And you're taking the word of somebody who's giving you wrong advice. Those are definitely really hard positions to be in. And as a consumer, as a real estate agent, I don't want anyone to be in that position. I want you to go and I want you to shop for a home and I want you to put that offer and I want you to feel so good about it. This should be an exciting time, not a heartbreaking time. So if there's any lessons I've learned this last week is when a buyer's coming back into the market and then what loan officers they're talking to. As agents, please hear me now when I say talk to that loan officer and ask them, not just if it's a full pre-approval, because if it's a soft pull, they can still say it's a full pre-approval. Ask them if it's a hard credit pull pre-approval. If it's not, have that discussion with your buyers because they don't know the questions to ask. And if you are a consumer who is putting everything on a soft credit pull, please get a second opinion. Please look up the information I'm telling you. And please know that right now, as it stands in the middle of 2026, I don't know of a bank that can close with a soft credit pull on a home purchase. That's my advice. It's real. And again, you've heard me say it before. I'll say it again. These are real people, real lives. They're real money, real emotions. It matters. We're not talking about $10. We're talking about hundreds of thousands of dollars. We have to take this stuff really seriously. And the deals I have where we work with clients and they want to strategize and they want to work with the best of the best and they want to sit down and know and understand and look me up and still go, okay, she's telling me the truth. Those are the buyers. Those are the real estate agents I want to work with. I want to work with people who want to get it done and want to get it done right and want to start the process and end with home ownership. So if you're a move-up buyer, let's get together. Let's do that full pre-approval. If you're a real estate agent, now's the time more than ever. The amount of save deals my team and I have done this year, now is the time more than ever to sit back and talk to your buyers about why their lending matters so much. Buyers just automatically assume that every lender is created equal, but we all know that's not the case. And in this environment where every deal matters, a buyer can actually negotiate things to protect themselves and get into a house at a fair deal, at a fair price with a fair interest rate. That's when you want to get in. This is the time. This is now. And I can't speak enough that you want to work with a team of people who you know have your back, that communicate and communicate everything, even the stuff you don't necessarily want to hear about. And if you want to talk more about the credit pulls, please contact my team and I. We want to talk further about them with you because it is one of those sales tactics right now that I'm seeing played more than ever. And like I said, there's going to be some people, they're going to walk away and they're going to be okay because they have strong credit, because they know what their credit is and they've been forthright with their client or with their loan officer. That's not everyone. And sometimes people truly just don't know what's on their credit to understand what it's going to show up as. They don't get it. They don't do this every day. I would never, I'd never call my real estate agent for financial planning advice. Not that a lot of them don't know it, a lot of them do. But I'm going to call my financial planner for financial planning advice. I'm going to call my lender for lending advice. I'm going to call my real estate agent for house advice. That's no different here. You're not going to put, if you're in a huge, massive lawsuit, you're not going to put your life in hands of an attorney just because they're the cheapest one. You're gonna go through the motions. You're going to interview them, and the one that's being honest with you, telling you what they can get you and what this is going to take to get there, that's the one you want to listen to. It's not the one that just tells you everything you want to hear. It's the things they tell you that you need to hear. And it's the same thing with real estate, same thing with mortgages, same thing with financial planning, same thing with insurance. So just make sure you're building a team around you that you know that you can trust. And to be honest, that you can put your hands around their neck and wring it if you need to. And the people on the phone, the lenders online, over the phone who you will never meet, who you will never see, who you know are not in your market, they're going to have no problem walking away. So just take that advice. I hope you hear it. I hope it rings a bell. And for those of you that have been in that, I'm sorry. I'm sorry you have, and I'd love to change your mind on lending and how we can make that work. Call us. If you want to be a homeowner and you want to figure out how to get that in, we're your team. You want to work with a strong team and you want to be a homeowner, we're your people. We want to help all day long and we'll walk you through it. We just closed a loan last week at a 530 credit score, but we strategized, we won. We closed stuff at 800 credit score. We strategized, we won. It doesn't matter who you are as a person. If you're interested in doing this the right way, our team wants to help you. Those are the people we want to work with. So thank you everyone for listening to me. I know it's a little bit of a rant, but you guys, it's real. And whenever I start to see real stuff, you know I'm always going to give it to you real talk. So I just wanted to spend some time on this one today because I don't love seeing people get burned, especially when they thought that they were taking great advice and didn't. So let's talk. Let's strategize a little bit more about you can ask when you're interviewing loan officers and the answers you should hope to get. Thank you again for keeping us on your podcast playlist. That was a mouthful, podcast playlist. But thank you for listening. Thank you. Share this with anyone you know looking right now. We want to make sure we're helping. And we'll see you next week on the Always On Point podcast here with Kristen Ambos.